The recent release of macroeconomic data that for the first time revealed the damage wrought by COVID-19 brought forward the need for an off-cycle meeting of the Monetary Policy Committee, that is the MPC, in lieu of the earlier scheduled meeting between June 3rd to 5th, 2020. Over the last 3 days, that is 20th, 21st and 22nd, the MPC reviewed the domestic and global developments and their implications for the outlook. After extensive discussions, the MPC voted unanimously for a reduction in policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth and to mitigate the impact of COVID-19 while ensuring that inflation remains within the target. On the quantum of reduction, the MPC voted with a 5:1 majority to reduce the policy repo rate by 40 basis points, 40 basis points from 4.4% to 4%. Consequently, the MSF rate and the bank rate now stand reduced to 4.25% and reverse repo rate stands reduced to 3.35%. Domestic economic activity has been impacted severely by the 2 months lockdown. The top 6 industrialized states in India that account for 60% of our industrial output are largely in the red and orange zones. High frequency indicators point to a collapse in demand beginning in March 2020 across both urban and rural segments. Electricity and petroleum consumption, which are indicators of day-to-day demand, have plunged into steep declines. The double whammy in terms of losses of both demand and production has in turn taken its toll on fiscal revenues. Investment demand has virtually been halted by a decline of 36% in the production of capital goods in March, which was coincident with a contraction of 27% in imports of capital goods in March and 57.5% in April. This is also evident in a fall of 91% in finished steel consumption in April and 25% shrinkage in cement production during March. The biggest blow from COVID-19 has been to private consumption, which accounts for about 60% of the domestic demand. The production of consumer durables fell by 33% in March 2020, accompanied by a 16% decline in output of non-durables. Similar indications are reflected in surveys of the fast-moving consumer space also. In the production sectors, industrial production shrank by close to 17% in March, with manufacturing activity down by 21%. The output of core industries, which constitutes about 40% of overall industrial production, contracted by 6.5%. In conformity, the manufacturing PMI for April recorded its sharpest deterioration to 27.4, spread across all sectors. The services PMI plunged to an all-time low of 5.4% in April 2020. Amidst this encircling gloom, agriculture and allied activities have, however, provided a beacon of hope on the back of an increase of 3.7% in food grain production to a new record. A ray of hope also comes from the forecast of normal southwest monsoon by the India Meteorological Department. In the external sector, India's merchandise exports and imports suffered their worst slump in the last 30 years as COVID-19 paralyzed world production and demand. India's merchandise exports plunged by 60.3% in April, while imports contracted by 58.6%. Headline inflation may remain firm in the first half of 2020, but should ease in the second half, aided also by favorable base effects. By Q3 and Q4 of the current financial year, it is expected that the headline inflation will fall below the target of 4%. Thus, the MPC's forward guidance on inflation is directional rather than in terms of levels. It is in the growth outlook that MPC judged the risks to be the gravest. The combined impact of demand compression and supply disruption will depress economic activity in the first half of the year. Assuming that economic activity gets restored in a phased manner, especially in the second half of this year, and taking into consideration favorable base effects, it is expected that the combination of fiscal, monetary and administrative measures being currently undertaken both by the government and the RBI would create conditions for a gradual revival in activity in the second half of 2021. Nonetheless, downside risks to this assessment are significant and contingent upon the containment of the pandemic and quick phasing out of social distancing and lockdowns. Given all these uncertainties, GDP growth in 2021 is estimated to remain in the negative territory, with some pickup in growth impulses in H2 2021 onwards.